More and more European investors are looking for ways to generate steady income from their portfolios, and covered call ETFs are getting a lot of attention. In the US, Goldman Sachs's covered call ETFs, most notably the S&P 500 Premium Income ETF and the Nasdaq 100 Premium Income ETF, have exploded in popularity, becoming two of the fastest selling ETFs in the first half of 2025. Today, I'll explain exactly what a covered call ETF is and highlight the best options for European investors right now. And stick around until the end because I'll show you how to buy them on Freedom24 and how you can get 20 free shares with this broker. Link in the comments below. Before we dive into the list, let's quickly cover what a covered call ETF actually is. A call option gives someone the right to buy a stock at a set price by a certain date. In a covered call strategy, the fund actually owns the stocks, say companies in the Nasdaq 100 or S&P 500, and then sells call options on those stocks. By selling these calls, the fund collects premiums, basically instant cash, which it then distributes to investors, often every month as dividends. The trade-off: if the market soars above the option's strike price, the fund may have to sell those stocks at the agreed price, capping your upside. But in return, you get more stable income and some downside cushion from those premium payments. In simple terms, a covered call strategy limits your potential upside compared to holding the stock outright, but offers a degree of downside protection through the option premiums collected. It's a way to earn income from your stocks if you're willing to give up some of the high growth spurts. Covered call ETFs have been trending because they offer something investors crave: steady, predictable cash flow. In choppy or flat markets, getting an 8 to 12% yield paid out monthly can sound a lot more appealing than hoping for big stock gains that might or might not come. Think of it as aiming for lower highs but higher lows. You won't catch the full upside of a huge market rally, but you also won't feel the full downside, and you keep collecting income along the way. This makes covered call ETFs particularly popular with income-focused investors like retirees or anyone who prefers regular dividends over volatile price swings. Now, if you're in Europe, here's the catch. Covered call ETFs based in the US are not available in Europe. Those Goldman Sachs funds I mentioned and other US covered call ETFs can't be sold directly to EU retail investors because they aren't UCITS compliant. UCITS is the regulatory framework in Europe for retail funds. This means your only option is to invest in ETFs domiciled in Europe, commonly in Ireland or Luxembourg, where many European ETFs are based. According to Just ETF, as of mid-2025, Europe hosts only a few covered call ETFs structured under UCITS regulations that are available to retail investors. It's still early days for this trend here, which explains why there are so few, but the space is starting to grow. The good news: we do have some options. Let's go through 4 of the best covered call ETFs in Europe that are worth knowing about right now. Here are 4 covered call ETFs available to European investors, each with a different flavor. We'll talk about what they track, their yields, costs, and what makes each one stand out. 1. Global X Nasdaq 100 Covered Call UCITS ETF. This fund targets the Nasdaq 100 with a covered call strategy. It yields roughly 12.1% as of June 2025 and has an annual fee, TER, of 0.45%. It uses a synthetic replication method, meaning it doesn't hold the actual Nasdaq 100 stocks, but uses derivatives to mirror the index's performance. If you're not sure what a synthetic ETF is, we have another video that breaks that down. The key appeal of this ETF is its high monthly payouts and stability of income. However, that comes with limited growth potential, since it's consistently selling calls on Nasdaq stocks. You're trading away some upside in exchange for that juicy income stream. 2. JP Morgan Nasdaq Equity Premium Income UCITS ETF. This one also focuses on Nasdaq 100 companies, but with a twist. It yields around 10.4%, with a lower expense ratio of 0.35% per year. Unlike the latest ETF presented, the JP Morgan fund is physically replicated. It actually owns the stocks and actively managed. The managers aren't just passively following an index, they have discretion to adjust the strategy, which can be an advantage in high volatility environments. Essentially, they aim to capture rich option premiums when tech stocks get volatile. The result is a high monthly income, but with an active approach that can slightly smooth out the ride. It's a solid option if you want Nasdaq exposure with a professional tweaking the covered call strategy in the background. 3. Global X S&P 500 Covered Call UCITS ETF. As the name suggests, this fund applies the covered call strategy to the S&P 500 index. It currently yields about 9% with a 0.45% annual fee. Like the Nasdaq fund from Global X, this ETF uses a synthetic replication method to track the index. It's a passive, rules-based approach, and it automatically sells calls on the S&P 500 holdings. Investors in this fund get monthly income and a bit of downside protection from the premiums, but in exchange, the upside is capped. You won't get the full benefit of a sudden S&P 500 surge. It's a nice pick for broad US market income if you are okay with slower growth in roaring bull markets. 4. JP Morgan Global Equity Premium Income UCITS ETF. This is a more globally diversified take on the covered call strategy. The fund's portfolio spans global equities. Think of an index like the MSCI World, and it writes call options on that broad basket. The yield is around 7% with a 0.35% annual fee. It's physically replicated, and like the other JP Morgan fund, it's actively managed. The big advantage here is diversification. You're not just tied to US tech or US large caps. You get a mix of regions and sectors, providing a steadier overall experience. The trade-off is that the yield is a bit lower than the Nasdaq or S&P focused funds, around 7% versus 9 to 12%, but you still get those monthly payouts. This ETF is a good choice if you want an income strategy that spreads risk globally, giving up a little yield in exchange for broader exposure and potentially a bit more equity upside remaining, since global markets don't all move in lockstep. So, you've learned about some covered call ETFs and you're interested in buying one. Freedom24 is a broker you might consider for this, since it's SISEC regulated and offers access to these ETFs. They're also running a special promo. New users can get up to 20 free shares. Check out our link in the description for details. Here's a quick step-by-step on how to buy a covered call ETF on Freedom24. 1. Once you log into your account, search for the ETF ticker, let's say QYLD. Choose the first one. 2. Click Invest. 3. After clicking Invest, you will be redirected to the trade window. Now you will need to click on Open a Session and follow the security steps. 4. Define the amount you want to buy. 1 share in our case, and the order type. We went for market price. Then click Place Buy Order. Please note that the QYLD is traded in USD, which means that you will need to convert your euros to dollars. 5. Just click on Confirm Purchase. And that's it. Your ETF will appear in your portfolio, and you'll start collecting those monthly payouts. All in all, covered call ETFs can be a powerful tool for investors who value steady income over maximum growth. The upside is capped, yes, but in return, you get more predictable cash flow and some resilience in volatile markets. It's about trade-offs, lower highs but higher lows. If you found this video helpful, then please give it a thumbs up, subscribe for more investing tips, and let me know in the comments which covered call ETF you're most interested in. Thanks for watching, I'll see you in the next one.